Welcome back into lesson 3. This is all about establishing what's called the buy box. Now, the criteria an investor establishes for the different types of loans they're willing to acquire, that's what you refer to as a buy box. So if a note seller asks you, what's your buy box? They're typically wanting to know the types of details we're going to cover in this lesson. The question about the buy box helps the seller or even a broker match the loans that you typically buy with the loans they may have to sell. Now, being able to answer this question comprehensively can be the difference between starting a relationship or not. A seller will often determine whether there's any opportunity to do business with you simply by the way you answer this question. And experienced note investors tend to put a matrix together outlining their purchase criteria or buy box. And it makes it easy for all parties involved once you put that matrix together. Now, one of the key characteristics to define when describing your purchase criteria for a performing loan is the property value, or what some refer to as the value band, which describes the range of property values you're comfortable with when buying a note. Now, for many investors, the minimum property value they'll typically get comfortable with is somewhere between $50,000 to $85,000. Now, the loan to value, often referred to as the LTV, is another important characteristic. And the LTV simply indicates whether the property has equity or is underwater. Now, some buyers are fine with borrowers being underwater and even prefer it because a higher LTV for a performing loan can translate sometimes into a higher yield. Now, this is because an underwater loan is sold based on the value of the property as opposed to the loan balance, or UPB. And when your purchase price is low relative to the loan balance, the yield can be very attractive. Now, speaking of investment yield, as a note buyer, you want to be able to discuss your hurdle or minimum return requirement when asked. Different investors have different cost of capital, and this has an effect on the minimum return they can accept. 6 to 14% is currently the range in which most performing loans are trading in the secondary market. The lower end of that range, which represents more aggressive pricing, would typically be for very clean loans, and the buyer at that 6 to 8% yield would typically be a bank or a fund with a very low cost of capital. It could also be an individual investor, perhaps buying a loan for their self-directed IRA. Quite often, you'll see performing and reperforming loans sold between 9 to 12% yield. We're going to shift gears to talk about pay history and credit score, because those are also critical components to the buy box discussion. Now, when discussing an acceptable pay history with a note seller, you want to be very specific. Now, you want to say whether it's okay for the borrower to have ever been late, or if you require 12 straight months of on-time payments. This means the borrower has never been more than 30 days late past the due date in the last 12 months. And the industry jargon for this is, you might hear a clean 12 by 12, or 0 times 30 the past 12, or it could be called a perfect pay or no lates. There's a lot of language to the note business, and that'll help you speak with a note seller in a language that they understand. Now, always to describe a pay history with no hiccups. When discussing the borrower's credit, you're going to want to specify the minimum acceptable FICO score. Now, a bank buyer will often want to see at least a 580 score or higher, and some investors will in fact want to see at least a 620 FICO. Another piece to a thorough buy box discussion will spell out whether it's okay for the borrower to have been modified or have a loan modification, as well as any bankruptcies. Now, most note investors will be okay with one modification, but some investors want to see a borrower, if they have been modified, make sure that they've at least paid for 12 months under that modification. So there's some history of them reperforming. And the same tends to apply for a bankruptcy file. Some investors will require that the borrower has made consistent payments on the BK plan for a minimum of 6 to 12 months. So let's shift gears and discuss the buy box in the context of non-performing loans, now that we've covered performing loans. While many of the same considerations apply as performing loans, some aspects differ, and sometimes they're the same, but they are just varying degrees of importance. I mean, for example, when you're establishing a buy box for a non-performing loan or NPL, it's critical to determine the geography. So these are the states that you're comfortable buying in. You know, some states are creditor friendly and others are debtor friendly. Texas, for example, is a very creditor friendly state. It's very easy to foreclose in most cases in Texas, but contrast that with New York, for example, very debtor-friendly state. And if you compare those timelines between the two, you find it takes on average about 246 days to foreclose in Texas, and it could take 5 times that long to foreclose in New York. And it's really not just the foreclosure that needs to be considered with non-performing notes. Once you foreclose, you're also sometimes dealing with an eviction process. So that's a key point as well. This is another reason it's so important to determine the minimum property value when determining your buy box with non-performing loans. When a borrower hasn't paid in many years, the interior condition of the home can be really rough. And for that reason, some investors will specify the degree of delinquency that they're comfortable with. In other words, a note investor might be okay if the borrower hasn't paid in, say, a year, but not okay if it's been 3 to 5 years since they've made a payment. And when you consider all the fixed costs involved, for example, foreclosure fees, it can be very tough to make the numbers work from a return perspective on low value notes because of these fixed costs. Occupancy status is another key consideration with non-performing notes. Some investors want the home to be occupied and others prefer it vacant. One reason for wanting the borrower to be in the home is your strategy may be to get them performing again or paying, and you may do a loan modification. Additionally, vacant homes in colder parts of the country where it'll freeze, they need to be winterized. And if it's vacant and it's not winterized, you risk busted pipes and plumbing, and it can be very costly to repair once you've foreclosed and taken control of the property. The big ideas in this lesson are establish a thoughtful and deliberate buy box, make it easy for sellers to do business with you, and understand the key loan criteria for buying performing and non-performing loans.